Ladies and gentlemen, good day and welcome to the KEC International Limited's Q4 FY2024 results conference call. We have with us today from the management, Mr. Vimal Kejriwal, Managing Director and CEO, and Mr. Rajiv Aggarwal, CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vimal Kejriwal, Managing Director and CEO, for his opening remarks. Thank you, and over to you, Mr. Kejriwal.
Thanks, Michelle. Thank you. Good morning, everyone, and welcome to the Q4 earnings call of KEC. Let me begin with an overview of our overall performance and then go into the specifics of each business segment and our key strategic initiatives. We have delivered a good performance for the year by achieving all-time high revenues, substantial improvement in profitability, key order wins, and significant improvement in working capital and debt levels. Additionally, we have successfully executed various strategic initiatives and developed niche capabilities across our businesses, positioning us for sustained growth. In Q4, we delivered the highest ever quarterly revenues of rupees 6,165 crores, a strong growth of 23% sequentially and 12% year-on-year. Our T&D business, especially India and civil business, have delivered commendable performances during the quarter. Our margins continue to show an upward trajectory with an improvement quarter-on-quarter over the last 6 quarters. We have achieved an impressive growth of 37% year-on-year in EBITDA, with EBITDA margins for the quarter improving by 120 basis points vis-a-vis Q4 FY23 to 6.3%. The bottom line has seen a remarkable growth with both PBT and PAT more than doubling over the previous year. Our PBT margin witnessed a significant increase of 150 basis points compared to Q4 FY23, reaching 3.1%, while the PAT margin expanded by 120 basis points, standing at 2.5%. In terms of order intake, we have secured orders of rupees 6,500 crores approximately in Q4 across businesses, largely contributed by India T&D and civil. Through concerted efforts, we have made significant improvements in our working capital and balance sheet. Our net debt, including acceptances, has decreased to around 5,090 crores as of March 31, 2024, largely in line with March 23 levels, despite a revenue increase of more than 2,500 crores, that's 15% Y-on-Y. If we compare it with the peak level of September 23, the borrowings have been reduced by 1,250 crores. The debt levels could have been much below 5,000 crores, but the spillover of collections of over 250 crores to the first week of April, including a substantial collection of 110 crores from Afghanistan. We have also achieved a reduction in net working capital by 21 days, now standing at 112 days as of March 31st, 2024, compared to a peak level of 133 days as on 30th September 2023. We expect continued improvements in working capital driven by better collections, commercial closure of projects, and a shift in the order book composition and quality, with a growing share of India T&D, civil, and product businesses. The positive trajectory of improvement in borrowing is also reflected in the reduction of the interest cost for the quarter to 2.5% of the revenue, a reduction of 150 basis points vis-a-vis peak level of Q2 FY24, and a reduction of 40 basis points vis-a-vis last year Q4 FY23. Coming to the annual performance, we have clocked a robust revenue growth of 15%, with the highest ever revenues of rupees 19,914 for the full year. The growth is backed by healthy execution in T&D, both in India and international, and civil businesses. In terms of EBITDA, we have delivered a substantial growth of 46% Y-on-Y, with EBITDA margins expanding by 130 basis points to 6.1% vis-a-vis 4.8% last year. Our PBT has increased by 2.6 times, and PAT has doubled to 347 crores against 176 crores of FY23. The revenues and margins could have been higher, but for the continued supply chain bottlenecks, especially in DI pipes for our water projects and high voltage transformers, GIS, and aluminum conductors for T&D projects. Additionally, the margins were impacted due to continued challenges faced in the execution of some of our railway EPC projects. On the order intake front, we have generally been very selective considering the working capital and margin profile of our various businesses. Notwithstanding the same, we have secured orders of rupees 18,102 crores. The largest contributor has been the India T&D business, followed by international T&D and civil businesses. Notably, 21% of these orders are for supply of products such as towers, cables, hardware, and poles. We have a well-diversified and strong order book of rupees 30,000 crores as on date. Additionally, we have a large L1 position of over rupees 7,000 crores, primarily in T&D business. With this, our order book plus L1 position stands at rupees 37,000 crores, which gives us a visibility for the next 6 to 8 quarters. We are happy that the order intake trend is continuing in FY25 with new orders of rupees 1,036 crores announced last week. Considering the substantial improvement in performance, strong order book, and ongoing confidence in strategy, the Board of Directors have decided to recommend a dividend of 200%, that is rupees 4 per equity share on the face value of rupees 2 each. Now, let me talk about specific businesses. Our T&D business has delivered a stellar performance by achieving a milestone revenue of rupees 10,456 crores for the year, a remarkable growth of 21% vis-a-vis last year. The growth has been delivered on the back of robust execution across both domestic and international markets. The business has significantly expanded its order book with strong order inflows of rupees 11,000 crores across India, Middle East, Americas, SAARC, Africa, and CIS. In India T&D, the business witnessed good traction as it secured orders of rupees approximately 6,000 crores, a robust growth of 40% vis-a-vis last year. Additionally, we are presently L1 in a large number of tenders in India. The business has significantly bolstered its order book with multiple orders for transmission line and substations from PGCIL, state utilities, private developers, and power producers. In India, the power sector is poised for promising growth with transmission infrastructure planned for major renewable energy potential zones such as Rajasthan, Gujarat, Andhra Pradesh, and Tamil Nadu to support the target of achieving 500 gigawatt of non-fossil fuel power by 2030. We have already secured some of these orders during the year and have a substantial order book and L1 of over rupees 9,000 crores as on date in India. The consistent flow of orders and focus of the government on renewables and the related T&D infra build reaffirm our confidence in the sustained strong growth of our India T&D business. In international T&D, we continue to expand our presence with multiple order wins across markets. The business has secured significant orders in Middle East, especially in Saudi Arabia and UAE through its UAE subsidiary KEC EPC LLC. We are progressing well on our debottlenecking program to increase the power manufacturing capacity at our Dubai facility by 20%. This strategic enhancement will enable us to meet the growing demands in the region and further solidify our leadership position in the Middle East transmission market. We continue to witness good traction in standalone tower supply orders. During the year, we have secured significant orders of over rupees 2,000 crores across key markets such as Middle East, North America, South America, Europe, and Australia. These orders include our largest tower supply order from the United States of America and the maiden tower supply order from Europe. The uptick in tower supply orders, particularly from North America, reflects the rising demand for our products in the region. In SAE, we have delivered a turnaround performance for the year with revenues of rupees 1,447 crores, growth of 9% and a positive PBT. I am pleased to share that SAE has delivered positive PBT across all the 4 quarters. In Brazil, we witnessed the largest ever auction exceeding $3 billion in March 24. We are in active discussions with developers who have secured these projects in the auction and are well positioned for securing orders both for supply of towers and for hardware. During the year, the business also achieved a breakthrough in the US market with the successful supply of hardware products, thus opening up new avenues for expansion and growth. The business has a steady inflow of orders and a robust order book and L1 position of approximately 3,000 crores, comprising of orders for supply of towers, hardware and poles, and engineering and testing of towers from the Americas. In Afghanistan, the progress on collection continues as we have realized an amount of rupees 110 crores in the first week of April 24. This brings the total collections post-regime change to a significant 420 crores. We continue to be in active discussion with the multilateral funding agencies for collection of the remaining receivables and are confident of realizing the balance in the coming quarters. The overall tender pipeline in T&D continues to remain strong in both domestic and international markets, given the push for renewables and requirements for large transmission lines, substations, and underground cabling. With a record order book and L1 in T&D of over rupees 21,000 crores, we are confident of delivering significant growth in this business. Our civil business has delivered an impressive performance for the year with a robust growth of 32% year-on-year with revenues of rupees 4,370 crores. The growth has been delivered on the back of strong execution across all segments. In Q4, our Honorable Prime Minister inaugurated the Kochi Metro Phase 1B, which includes a viaduct and a station built by KEC. Incidentally, the Balastas track works for Kochi Metro was also executed by our railway SPO. The business has bolstered its order book with order inflows of over rupees 4,200 crores. During the year, the business has secured multiple orders spanning diverse sectors including FMCG, metals and mining, cement, residential and commercial buildings, and data center segments. The business has also expanded its customer base with the addition of multiple prestigious clients. With a pan-India order book of over rupees 5,000 crore in industrial and building segment, we have established ourselves as a preferred agency in the construction of residential buildings and factories. The business outlook remains healthy across segments with a robust and diversified order book and L1 of over rupees 10,000 crores. We are confident that civil will continue to be a major growth driver for us. Our railway business has achieved a revenue of rupees 3,115 crore for the year, degrowing by 17%. The business is progressing well on the completion of existing projects. We have successfully commissioned our maiden tunnel ventilation project in Jammu Kashmir. Our execution is on track on the prestigious TCAS train collision avoidance projects under Kavach. During the quarter, we have enabled Kavach system on 70 route kilometers and another 100 route kilometers is planned during the month. The margins of this business continue to be impacted adversely due to the delay in execution on account of various factors such as availability of blocks, design issues, etc. As conveyed earlier, we are being very selective in order intake of railway business considering the increased competition, customer and margin profile and working capital. Consequently, the order intake and L1 for the business remains subdued at rupees 1,500 crores. This will result in a further degrowth in revenues in the current year. In a significant development, we have commenced execution of our first international order secured during the year. We have witnessed significant infrastructure spending of the government towards increasing freight carrying capacity, rolling stocks and Vande Bharat trains. Going forward, we anticipate increased allocation towards conventional infrastructure development within the railways encompassing the construction and upgrading of tracks, overhead electrification and advancements in signaling and telecommunication to facilitate the seamless operation of high-speed trains like Vande Bharat. Our focus will be on fast-tracking project closures, optimizing working capital, and pursuing select opportunities in India as well as in the international market. In oil and gas pipelines, the business has delivered revenues of rupees 626 crores, a good growth of 30% vis-a-vis last year. In a noteworthy achievement, the business has forayed into the international market by bagging its maiden order in Africa. We are also exploring opportunities in the growing storage tanks market. The business has also strengthened our composite station works portfolio by securing one more order in this segment. The business continues to focus on enhancing pre-qualifications to expand the size of addressable market. In the solar business, we are currently executing our largest 600 megawatt solar project in Karnataka. Additionally, we have also secured an order for setting up solar projects from a leading auto ancillary company in India. We continue to bid selectively for opportunities in line with the sustained commitment of the government to promote renewable energy. We firmly believe that the renewable EPC business will become a significant contributor to our future growth. Our cables business continues to deliver good performance with the highest ever revenues, order intake and profitability during the year. The business achieved revenues of 1645 crores with substantial improvement in profitability. We are progressing well on setting up the fully integrated manufacturing line for aluminum conductors announced last quarter. The business has already secured orders for supply of power transmission conductors, ACSR and AL59 from government utilities and private sector PVCV developers. This strategic move will contribute significantly to the revenues and margins of the cable business. Additionally, it will also enable us in timely execution of our own T&D projects. We are confident that this business will continue to grow in terms of revenue and profitability. Over the past couple of years, we have undertaken a transformational journey to create a world-class engineering organization to enhance our engineering prowess across business segments and gain competitive advantage in the industry. We have re-engineered and automated end-to-end design processes to reduce engineering cycle time, leading to significant improvements in both efficiency and design quality. Furthermore, we have deployed leading-edge digital technology such as AI, advanced analytics, NLP for engineering design optimization and improving the quality of our submittals to the clients. This program has helped us to improve our engineering-led wins, enhance profitability across various businesses, and position as a preferred partner for infrastructure projects. In ESG and sustainability, we continue to take significant strides across the organization. Some of our key initiatives and developments during the year include installation of solar rooftop at our Brazil plant and in the process of expanding capacity of our solar rooftop at Nagpur, in addition to the existing solar rooftop plants at Jaipur and Dubai. With this, 25% of our total power requirement in the plants will be catered through solar energy. We also have long-term agreements with external service providers who provide energy from renewable sources at our Vadodara and Mysore cables manufacturing plants. Our people-centric agenda focuses on fostering happiness as reflected in our brand tagline, Hello Happiness, an integral part of the RPG Group's philosophy. The success of this agenda is reflected in the increase in our happiness quotient to 83% this year, vis-a-vis 81% last year, owing to our unwavering commitment to employee-centric initiatives encompassing growth, culture, recognition, and work-life balance. In the past 2 quarters, our board of directors has undergone notable changes. 3 directors have joined our board, while 2 members have moved on, adding to the diversity, knowledge, and expertise of the board. We now have a further diversified independent board of 11 members, comprising of ex-bureaucrats, investment bankers, finance and sustainability professionals. I'm glad to share that our progress on this front has been well appreciated, which is reflected in the continuous improvement of our ESG ratings by S&P Global, DJSI, and Morningstar Sustainalytics in the last 2 years. In a proud moment, we have been ranked first in our industry by both these agencies and also made ourselves as a part of the top quartile of our industry globally. In conclusion, I would like to emphasize that the outlook remains healthy across most of our businesses, with a formidable and diversified order book plus L1 of rupees 37,000 crores, combined with a substantial tender pipeline exceeding rupees 1,35,000 crores. We are well positioned to deliver sustained growth in the forthcoming quarters. We will continue to focus on profitable growth, fortifying our balance sheet, and investing in building capabilities across our businesses to lay a strong foundation for the future. Thank you all. We are open to questions now.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renu Baid from IIFL Securities. Please go ahead. As the participant has left the queue, we will move on to the next question, which is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Hi. Good morning, sir.
Hi, Mohit.
Congratulations on decent set of numbers. So my first question is, sir, how do you think about the opportunity in India, T&D, especially in FY25? If I heard correctly, I think you mentioned we received an order of 64 billion. It's a 40% growth YOY. In that context, is it right to believe that the FY25 could be a very, very large number? And also, can you just comment on the competitive intensity?
Mohit, your question was not very clear to me, but I think you're talking about India T&D growth.
Yeah, I'm talking about India T&D opportunities. And lastly, I think we did a number of 64 billion. Can you see a materially high number in FY25 given that there is a large bidding has happened in FY24?
I think clearly we are seeing a large tender pipeline happening. We are seeing new renewable, I'll say, packages being announced by the government. The Rajasthan part, I think, is slowly coming to an end, but I think it's moving on to others. We recently had one more big opportunity announced towards the Jamnagar side where all the large renewable projects are coming up. Also, the HVDC has gone into tendering. So we are also seeing, I think next week or maybe a week, 2 weeks after that, the first HVDC tender line will get tendered out. The second one is also there. So I think India T&D, we grew by almost 40-45% last year. We are again planning another 40-45% growth this year. As of today, if you ask me, we have a 25,000 crore tendering opportunity right now live. We are having discussion with all the players, including Power Grid on this, and I can see them that they are very bullish. In fact, I think they are probably going to revise their capex plan. So if you ask me, I think we have never seen such good days in India T&D, and the way the government continues to focus, and I do hope that they will continue after the elections on the renewable part. The other piece is if you look at the huge program which has been announced for setting up of coal-based plants, thermal plants, I think that, and those plants will obviously come at pit heads, etc. So again, the lines for this will also be required. So that would be a second part of the growth story of India. So I think very clearly we are right now very positive on the India growth story, which is completely opposite to what we were talking about a year back. It's been a huge turnaround.
So is it right to expect a double-digit margin in the India T&D?
I'm sorry to interrupt, sir. I would request you to keep your mic a little bit farther from your mouth and speak.
Is it better now?
Yes, sir. Please continue.
Slightly better, yeah.
Yes, sir. My second question is, given that the large opportunity and given that there are limited players available to execute these projects, is it right to think that the margins on the Indian T&D space, especially on the standalone, could move to double digit?
We expect that to happen.
Well, the answer is it likely in FY25 or FY26 in your opinion?
FY25.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good morning, team. So my first question is on the core T&D business. If you see now for the last 2 to 3 quarters, our order backlog has been in 14 to 15,000 crore rupee range. And typically given that the order book to bill would be about 15-18 months, what in your view could be the T&D revenue growth in fiscal 25? Or you think we can continue to clock 15-20% revenue growth, or it may take a bit of knock until new order flows come in the backlog?
Renu, good to see you back in the conference call. I think we are very clearly targeting around, I'll say slightly, at least 20%, if not slightly more in the T&D piece. Largely driven by India because international has grown very well in the last 2 years. India had a very low performance in FY23, picked up in 24, 25 again. So I think we'll grow by around 30-40% in India. So overall, if you add India, international and SAE, I think we should have around a 20% plus growth in T&D as a whole.
Sure. And simultaneously, while SAE is now turned around, and if you look at the core margins, profitability for this year were definitely impacted because of low projects, old projects. So this year for fiscal 24, the last year, what was the approximate margin profile of the T&D, say X of SAE? And you have indicated in the previous Q&A that you're targeting double-digit margins in T&D. Do you think that is feasible for 25 or there could be risk? Or what could be the risk or challenges to double-digit margins in T&D in fiscal 25?
So, Renu, as far as the risk is concerned, we are largely, I'll say, almost hedged on all our base metal exposures. which would include aluminum, copper, as well as zinc. Steel is something where there's no significant hedging mechanism available. So that, to me, that's one exposure which we'll continue to have, although we are not seeing any major movement in steel happening in last 2 quarters. And I think our supply chain team is also confident that they don't see a major movement happening in this. The second risk would be slowdown in execution, which I think we have built up enough teams and all that. So I don't think, so per se, I am not seeing any major risk on the T&D side in delivering our projected revenues, and I'll even take on the margins also.
Okay, and approximately what was the profitability of T&D portfolio in fiscal 24?
We don't give out our numbers like that, but I can tell you that it was non-T&D was slightly lower than the T&D.
Okay, got it. Second question is, rail order book also is now just at one-time book-to-bill, and given that order finalization pace is slightly softer in the rail electrification EPC space, what kind of consolidation are we heading for in fiscal 25-26 in this business? And in your view, can this be materially offset by build-up on export exposure, or it may be still some time away till we build up the export order book here?
So I don't think it will get set off by export immediately. Right now, we just have one single order which is under execution, and we have bid for a few of them. Now, by the time those orders come, and hopefully we'll get at least one or two of them, I don't see revenues coming in earlier than Q4 or something. So clearly, FY25, we will have a further degrowth of 15 to 20% in our railway numbers. Okay. Now, coming back to how this business will grow or what will happen on this, I think we'll have to wait and watch once the new government is formed. What is the focus area of them in the railway piece of it? Okay. Because pre-election, we did see a huge amount of spend which was on running new trains, station development, etc., which were, if I want to use the word, more populist than on the infrastructure. But the view in everyone and whoever we talk to in railways and all that is that ultimately we will need to build infrastructure for all these new trains. So we are hoping that, and I think we are reasonably confident that the spending pattern of railways will change and will move towards more infra, which is where we are. So I do hope that we will start seeing new tenders and orders coming in maybe in Q3 or something, and then revenues FY26. So to ask me, we should see a turnaround happening in the revenues and hopefully the margins also from FY26.
Got it. And lastly, you did elaborate briefly about the foray into conductors portfolio. So what is the kind of capex outlay that we have planned for this business to build capabilities and capacities? And what could be the targeted asset turn from this portfolio, even if it is for internal consumption initially over the next 3 to 4 years?
So, Renu, the target, as the capex right now, we have targeted around 60 crores or so because it will come up in our existing Vadodara factory. And the turnover, I think if you look at the current prices, which are slightly elevated in terms of AL59 and all that, should be around 10 times. So we should be, in a full year basis, we should be able to achieve a turnover of around 600 crores from this capex of 60 crores.
Okay, and this 60 crores is sufficient enough to build all the EL range as well as the ACSR range that we are expecting?
This is a complete line by itself. Got it.
And lastly, if I can just ask one more, if you look at the government commentary in the last few months, as a part of the 100-day program, it is speculated that there will be significant thrust on new project approvals in T&D and power sector. And that, in your view, how incremental can it add to the domestic growth outlook that you have shared with us so far?
It's a difficult question because I'll tell you why is that even without incremental output and all that, right now there are so many orders going on in the market. Okay. As I said, we are looking at almost 40% increase in our India turnover this year on top of the 40-50 we already had. So I don't think it will impact too much, because at the end of the day, I think we are also seeing a significant stretch on the supply chain. Mm-hmm. So I don't see that whether we'll be able to go beyond 40-50% of the current revenues for India, unless and until we have matching spend happening on other items. Like, we are also looking at, should we expand some of our India factories also? We have not yet taken a call. Maybe if this thing happens, maybe we may take a call on that, because right now our factories, all of them, India as well as Dubai, are full.
Got it. That's pretty helpful. Thank you so much, and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yeah, good morning, sir.
Good morning, Bhumika.
Yes, sir. So just wanted to, discuss the margin profile. The improvement what we were looking at has been, the recovery in margins has been much slower. And I think that's got to do with the railway segment. Now, if you can just throw upon, what has been the railway margins like? I mean, while we're looking at a decline in the revenues for FY25, how will the margin profile for the railway business kind of pan out, which will start reflecting then the healthier margins of T&D?
So, Bhumika, the margins are not as per your expectation or our expectations also. We were expecting a slightly higher margin in Q4. Now, there are basically two reasons why the margins are, I'll say 20, 30 basis or maybe 40 basis points below the expectation. And one reason is that we had a deferment of revenue, which is unfortunate on account of some of our supply chain issues, which are common to the industry. People admit it or they don't admit it, but there are issues which we are facing on, especially on the conductor and transformers, etc., and a little bit on the Red Sea, where some of our shipments from Europe got delayed. So we would have lost around 400-500 crores of good revenue. So if you take a 10% margin on that, roughly around 40-50 crores of margins, which would have added around 20-25 basis points to our profits, has not happened. So that's one reason. And the second reason is that, as you rightly said, railways has been an issue. We have been trying to see how do we recover all the variations and prolongation, etc., which we had hoped that at least some part of it would come in Q4. Unfortunately, there have been some management changes in some of the PSUs, etc., and somehow I think those decisions got delayed. So whatever we were expecting has not come into account, and because of that, we have actually booked some extra provisions in the Q4. That's the basic reason why the numbers are 30-40 basis points below what we would have wanted to have for Q4 also, and what we had been talking earlier.
Okay. So, sir, I mean, while we're guiding for a 7.5% margin for the full year of FY25, when do we start seeing margins, at around 8 to 9% kind of a range, which would be closer to the T&D margins per se?
So, Bhumika, we still maintain that we'll have 7.5% plus. We were talking about 7.5 to 8, but okay, let's stick to 7.5 for the year. We have also said that exit at FY25, we should be close to double digit, anywhere between 9 to 10%. Quarterly, maybe Q1, Q2, we're still ramping up, so it may be at a slightly lower level in terms of, I don't have numbers for that, but Q3, Q4, you will definitely start seeing margins of that side so that we can deliver an average margin of 7.5 for the year.
Sure. So the second question is on the T&D aspect of ordering and competitive intensity. As you mentioned that, the demand and the ordering activity is picking up quite a bit. Simultaneously, if you can comment about the competitive intensity, a lot of new players have kind of come back. Jyoti Structures, which was not there earlier, is also bidding now. So how is the competitive intensity in T&D for these new orders? How was it, say, versus 1 year back and now, the number of players bidding for orders, etc.? If you can just talk about that aspect.
So, to me, Bhumika, what has changed in the T&D sector is the size of the orders. Typically, what we are seeing now from Power Grid especially, most of the orders are 500 crore plus. Okay. And if you look at the competitive intensity in that segment, I'll say it has probably come down a little bit. Not gone up in that segment. Okay. The other players whom we are talking about are still not there in Power Grid, and they have been more with private players and smaller jobs, etc. So if you ask me, an honest answer would be for the larger projects, the company intensity has not gone up. In fact, I would say that it has come down slightly.
Okay. And in terms of tendering opportunities, sir, you said 25,000 crores is what is the tendering opportunity which is ongoing right now. As a year as a whole, what do you think can be possibly the kind of orders that is being talked about, and what is in the pipeline which can possibly come through for the year in terms of tendering opportunity?
Typically, we have seen around 55,000 crores of opportunities coming in, but this year I think we'll do much more than that. The way the things are happening, I think we'll probably end up at 70,000 crores of numbers.
Okay, and that will be then bolstered by the international business as well.
No, I'm talking about India. International would be around, right now we have tendering opportunity of almost 40,000 crores in international today.
Understood. Got it, sir. I'll come back in the queue. Thank you so much.
Thank you.
Thanks, Bhumika.
Thank you, sir. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi, Vimal sir. Congratulations on a decent turnaround this quarter.
Thanks, Parikshit.
So, my first question is on this 11,000 crores of inflows which you highlighted in the T&D segment. So I just wanted to understand within this piece, what could be the total bought-out items, equipment, transformers, substations. So basically the third-party procurement on the equipment side. And are you seeing any inflation here? Because we have seen a 40% growth, which is substantial, the inflows. So if you can help us understand how much could potentially be a breakup on inflation and volume in this.
Parikshit, it will vary from order to order, but typically I'll say construction varies between 20 to 30%. Okay. On the international side, the construction costs go up to probably 40% also. India would be close to 20%. Substations could be between 10 to 15%. So it would vary, but you want to take a ballpark, maybe 20% would be construction, 80% would be supplies. Of the supplies in transmission side, 30% would again be towers which would come out from own factory. So maybe 35-40% would be bought out for transmission projects. For substation, it would be closer to 80% bought out. So that's the broad numbers. They could vary slightly, but that's the broad breakup of the revenue of transmission and substation. As far as inflation is concerned and price increase is concerned, clearly we are seeing that. But what happens with us is that when we bid for a tender, we generally have a back-to-back offer with vendors, whether it's for transformer or GIS or conductors or anything. Conductors obviously normally is on a price variable where, the metal moves in back and forth with what happens with the LME. But as I said earlier in the call, that we are fully hedged on all of them. So as far as the past, what we have in our order book, I don't think we see any exposure. For the new ones, we quote based on the increased prices. That's why one of the questions which I answered to Bhumika was also that the size of the orders is increasing. And so partly it is because of the volumes are increasing, partly because the values are increasing. I remember we recently quoted a tender with AL59 conductor, where the conductor value was almost 40-45% of the entire contract value. But for us, we are very clear that we always hedge the moment we are L1.
But our high voltage supply chain, the large MNC players, so typically what kind of contracts do we have with them? Is it like pass through or is it fixed price? So once we close the contract and award them, is it a fixed price? So how do we hedge that exposure?
So typically the GIS would always be on a fixed price. Okay. Transformers, it depends upon, contract to contract. There are contracts where we could have a pass through if the client is giving. There could be contracts where there is no pass-through, where we take a call based on our supply chain. But typically those exposures are pretty small. And also if you look at the TBCB and all, the way it operates is that before the final offer is submitted, Power Grid always calls you back for a revised offer where you can always take corrective actions on the pricing. So if you ask me honestly, I don't think today we are looking at a large exposure on the base metals in the open market.
Okay. So second question is on the improving health of the balance sheet. So now I just wanted to understand, typically fourth Q is very good in terms of collections. So going in the ensuing quarters, coming quarters, how do we see the debt shaping up from 5,000 crores level? And also if you can touch upon why didn't the credit rating agency see this improvement coming in, and despite that they went for a downgrade, because now things are looking up. So what were the discussions, deliberations about going around like improvement on these matrices? Despite that they took a downgrade. So if you can help us understand.
Maybe I'll ask Rajay to answer, then I can add something if required.
So basically, on the debt side, we are expecting that some more collections to happen. For example, Afghanistan, and there are few other debtors which are still coming up with the project closure. So we expect that with the 15% growth in the turnover which we are expecting for the next year, we should remain by and large with the same debt level of 5,000 crores. So effectively what we are saying is that our NWC days, which is currently stands at about 112 days, will go down below 100 days. So with that, 15% effectively debt reduction indirectly will take place with the same debt continuing. And based on that, we expect that the interest cost will go down to 2.5%, which is currently at 3.3% for the year. As far as your question on the rating agencies rating downgrade is concerned, I think clearly the rating agency has taken a call based on a number of Q2 and Q3, and obviously a lot of debt reduction has taken place in Q4. At the end of Q3, we had a debt of close to about 6,200 crores, which has significantly reduced in quarter four, and we expect the lower quantum should continue for the rest of the year, because there are a lot of leeway that is available still with us in terms of more collection happening throughout the year. So maybe with after a couple of quarters with further improvement, we will go back to the rating agencies, and we will request them to look at our revised numbers and consider the restoring back our rating. Currently, there are other two rating agencies which continues to be at AA minus. So with the CARE and CRISIL, they continue to be at AA minus. Incidentally, our short-term rating continues to be at the highest grade. So that is A1+, even with the ICRA.
But Rajiv, with the increase in volume, do you think the debt levels will go up like in Q1, Q2? I know Q4 they may again come back because of strong collections, but in next 3 quarters, do you think, what could be the peak debt levels we are factoring in for the next 3 quarters?
So normally this is like, if you look at the, seasonal phenomena where generally in Q1 and Q2 the debt level goes up, and Q3 and Q4 the debt level comes down. So we had a peak debt level in Q2, and wherein the interest cost was also corresponding to that at 4%, and from 4% we have come down to 2.5% in Q4. So this is a normal phenomenon. So probably my sense is that debt level will always vary between 5,000 to 6,000 crore, and 6,000 should be the peaking level, given the lot of collections which is lined up in the next few quarters. Even 110 crore, as Vimal said at the beginning of the call, that we collected from Afghanistan, which came on 4th of April. So had it been on 31st March, 4 days before, probably, the debt level would have further gone down in the March itself.
Okay. And Vimal sir, you'd like to add something on this?
No, I think we did request the rating agency that we should look at the annual accounts numbers and all that, but I think they had their own timelines, etc., so they went ahead for it. So I think we are very clear that we will be able to, once our numbers are sent to them and maybe Q1, etc., we should see some improvement. Let's keep our fingers crossed. But I think overall, what is also happening, Parikshit, is that with our quality of order book, etc., improving, I do feel that the numbers on cash flow will improve. There are quite a few large projects, both in civil and also in railways you have looked at, where we expect, commercial closures and cash flows which have been, sort of in the pipeline will start coming in. So I think overall, the balance sheet, the debt profile will definitely see a significant improvement.
Okay. And so just the last question on the order inflow. Last year we had a miss in the guidance. the order inflows. So just wanted to understand what were the reasons behind that, and what is the guidance for FY25, and I mean, will it be sufficient enough to make up for the loss we had so that we can deliver a 15% growth?
So FY25, we are targeting around 25,000 crores. That's the easier answer for me. On the miss, I think there are two. I'll say part of it is a deliberate miss because we really went slow in some of the sectors where we were seeing a cash flow issue and also somewhere some execution issues. So I'll say part of the miss, I can't put a number, but maybe 2,000 or 2,500 would have been on account of deliberately not picking up orders or not bidding for some of the tenders which we had factored in as we will win. And second is one or two cases where we were L1. Unfortunately, we could not take the orders because of renegotiations and the numbers which the client were asking us were below our threshold, etc. So we had to leave out a couple of orders. Which had we accepted them, we would have met 22,000-23,000 of our target. So I think that's what it is there.
Okay. Okay, sir. Thank you and all the best.
Thanks, Parikshit. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Vaibhav Shah from JM Financials. Please go ahead.
Yeah, thanks for the opportunity. Sir, in terms of margins, what margins are we targeting for 25 and 26 on a whole? And in terms of segmental margins, can you just provide a brief range of what were they in 24 and what we are expecting the improvement in the next 2 years? A broad range would do.
So FY25, I just answered, we are looking at a 7.5% margin for the full year. And we also said exit should be around 9% or 10%. So I presume that FY26, we still have not got our numbers because it will depend on orders and all that. But I think we should be close to double digit, at least 9%, if not 10. Very difficult to give a number for 26, but clearly it will be, I think, 9% plus.
Okay, sir, in terms of segments, can you provide some clarity, a broad range?
No, so I think the way things are happening today and with the India T&D market looking up significantly, the way things are happening, I think the T&D margins will definitely be higher than the non-T&D. I can only tell you that much.
Okay, sir. So secondly, what would be the outstanding debt in SAE and interest cost?
Interest, I think overall, SAE cost around 11%. Debt
is about $50 million.
$50 million is the debt in SAE.
So are you planning to reduce the debt or replace it with some other from our side, or it will continue at that level?
I think we are waiting for the performance. I think performances are improving, so there's some natural reduction. Also, we have seen last year a reduction in the Brazilian interest rates. So hopefully we should be able to refinance. And also, I think the balance sheet has improved, so we should be able to get a better internal rating of the banks in Brazil. So I think the rates should start coming down. Right now, funding from India would obviously be at a cheaper rate, but I think we would still try to see if we can finance Brazil by itself. So looking at it, if nothing happens in the next 1 quarter or 2 quarters, we'll probably do some capitalization there if required.
Okay, thank you. So those are my questions.
Thanks, Vaibhav.
Thank you. The next question is from the line of Seth Saurabh Gujjar from ICICI Prudential AMC. Please go ahead.
Yeah, thank you for the opportunity, sir. In your starting comments, you mentioned about slower execution due to something like HV transformers, aluminum conductors, all these, right? So when we are targeting, say, 20% growth next year, how do you see availability of these and the supply chain shaping up, both in the near term, say, 2-3 quarter view, as well as slightly medium to longer term supply chain shaping up?
So as far as the 20% growth is concerned, there are 2 parts of it. Actually, 3 parts. One is India, one is international, and one is SAE. So we are not seeing, there is a problem, but we are not seeing that much of a stress in international as of now. India, I think, has been more of a stress on conductors and to an extent transformers in GIS. But for our plan for this year, we have a tie-up with all the vendors on the supplies. So I don't think we are worried about it. conductors was still a little bit of an issue, which is why we decided to, set up our own manufacturing. So I don't think the 20% is at risk because of the supply chain issues. No.
Sure. And second question is on this HVDC. So say if a HVDC opportunity coming up, if you take an index number, say 10,000 crore HVDC contract, which would have multiples of opportunity for both equipment players and for players like us. So broadly, how do you see out of the 10,000 crores, say HVDC project, what would be an addressable opportunity for us, for EPC players like us?
It would depend upon the structure of the bids. Like we are right now doing an HVDC where the main equipments are supplied by the manufacturer, and we are doing the entire civil. We are also doing mechanical, erection, and many other items of that. There obviously our share would be higher. Recently, one of the bids which has come out with Power Grid is where they have segregated civil completely and supplies and erection. So it would depend, and so obviously the value goes down there. So it would depend upon what shape and what format the bids come up. As far as transmission lines are concerned, I think we are seeing opportunities of probably 2,500-3,000 crores out of that 10,000 as transmission lines. So that's the opportunity in each of them. Even now we have got a large number of lines to be bid both in India and Saudi, where there are huge HVDC lines which have been announced.
So, just a follow-up on that, say the Power Grid project you mentioned about, in that within the total project cost, what would have been the EPC package split out of the total project cost?
I don't have the exact number, but I think the civil was around 1,000 crores or odd, okay, for the GIS, for the HVDC converter stations, and transmission lines would be probably around 2,500 or 3,000. If you ask Abhishek later on, he will give you the exact number. But I think it's roughly between the two put together, it would have been around 3,500 or so. Plus, what will also happen is once the converter station is, let's say, won by someone, maybe they may come back to us for the balance portion of the converter station also, which can probably add another 200, 300 crores or maybe 400 crores for us. So it may end up with around 3,500-4,000 crores in a way.
Okay, sure. Thanks, sir, and all the best.
Thanks, sir. Thank you.
Thank you. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Hi, sir. Thanks for taking my question. My first question is on the railway business. So, railway, you did highlight it that this year also there would be degrowth. We have seen railway business for you growing from almost 300-400 crore to 4,000 crore between 17 to FY22. Directionally wanted to understand, since there's a degrowth for FY25, and you did highlight it that there's a working capital which is an issue from almost 2 years, and the margins are quite low. So what is the strategy for us over the next 2-3 years in railways? And second thing, wanted to understand from you on the conventional railway versus non-conventional railway. Will there be more focus on the non-conventional railway projects going forward within railway? So some sense on where it would help. Yeah.
So Amit, last year we decided that we will go slow till we, get our act together, wherever the issues are, understood the contractual issues and where we are running into right-of-way blockages, etc. So I think we now have a reasonably good understanding of it. How do we get back and whether we'll get back and all, to me, will depend upon how the contracts are now structured. Already we are seeing some changes in the working capital structure where earlier it was completely milestone driven, that you do 10 kilometers and you get paid for 10 kilometers. And now already some of the new tenders, they have agreed that, for supplies they'll pay separately, etc. So if the contract structure changes where it becomes a little bit, more friendly for working capital, number one. Number two, how the new government and the ministry, etc., look at some of the clauses of EPC. I think all that would decide on how do we look at the conventional railway business. the second. So this is basically on, construction of new lines, doubling, tripling, etc. On the technology front, whether it is PCAS or whether it is block signaling or SNT, etc., I think we will continue to look at it and see what is to be done. Between conventional and non-conventional, I presume non-conventional, one is the technology part of it, one is the metro part of it. Metro, we are bidding. We have got a few projects on Balas West track. We are L1 right now in a project for power supply to a metro organization. So I think we are in a way, I'll say we are sort of agnostic to what projects we get, depending upon the margins which are there on in individual tenders. Internationally, we are looking at closely, but I still feel that 25 we will continue to degrow, and 26 onward we should see a turnaround happening in the railway business.
Sure. So next on the civil business, again the similar thing. So we got to almost 6,000 crore intake, FY22, FY23, and this year we are at 4,000 in civil. Despite your commentary on civil was pretty strong with respect to the prospects on building factories and the civil work on metro side. So just wanted to understand, is this the area which you just highlighted that deliberately going slow because of the pace of execution or payments, or anything you would like to highlight on going slow on civil as well? Yeah.
So Amit, the commentary was strong basically on the revenue side. We had a large growth of more than 30% on the revenue. Order intake, I think the simple reason was that we more or less stayed away from very large projects, especially on the metro side. We have 4 large metro projects under execution, and I don't think we are very happy with what's happening on the cash flows, and we are facing a lot of delays on account of utilities, etc. So we decided to be a little bit more conservative on that till we complete some of these projects, which I think we should in the next quarter or two will start completing and handing over. And secondly, we also did not see too many water projects coming up. See, we have got an order book of almost right now 3,500 crores in water. And where, for some strange reason, we did not see too many projects coming up. So basically, we sort of, I'll say, deliberately stayed away from metro. Water, the opportunities were not there. So some of the large projects, which is what we had secured in FY23, were not there. So if you look at our order intake for this year, it's primarily industrial and residential, and I think one data center, if I'm not wrong. That's and obviously an hospital, etc. So all these orders were in the B&F sector, as you want to call it. So I do hope that next year, with the new government coming in again, I think metros and all that will start coming in. So we will see. We do hope it will work up on that. But otherwise, on residential and industrial, and especially now we are seeing private capex slowly starting to go up. Okay, residential, there are more than enough opportunities. And so once the elections are all over, I think once we start getting labor, etc., we'll probably pick up a few more jobs and add to our order intake there.
Sure. So lastly, on the order inflow miss this year, we closed at about 18,000, and you did highlight it that deliberately went slow on a couple of projects, and competition-wise, we did not got a couple of projects. Wanted to understand which segments was this missed in FY24. And the second part is the 25,000 crore revenue intake which we are factoring in. What kind of intake segment-wise we are dissecting there? Yeah, that is my last question.
So I think if you, I was not very clear. I think the sound was not very clear to me. But if you're asking about competition and all that, so obviously international we see international T&D we see some degree of competition going up, especially in Africa and all that. India, we have not seen significant competition either in T&D or even on the larger civil projects. If you take civil projects of 500 crores and above, hardly 3-4 players and all that. If you're going sub 200, then we are seeing a lot more competition. I think the biggest competition problem which we see is in railways, where in many of the bids we are seeing 15 players, 17 players, 20 players, largely from the, I'll say, road industry or contractors to the road industry, subcontractors to the road. I think those are the guys who are coming in. So to me, if you look at it that way, Even cables, we have been seeing some competition happening. There are at least 7 or 8 players in most of the cable orders. So that's the way we see. India T&D lower, then civil, then probably international, then cable, and then railways in that order of increasing competition.
Yes, actually wanted to understand the 6,000 crore miss in order intake this year was in which segments?
But I had explained that earlier, saying that we had explained it earlier, saying that we had deliberately not taken some orders which are more in the T&D sector where the negotiations were happening and they wanted lower prices and that was going below our threshold. And secondly, in railways, we went very careful in what of orders we will take. So I'll say, and part of, so it will be a mix of civil railways and part of international T&D. And even India also, some of the private developers, we said no.
Sure. So lastly, some color on 25.
Amit, you have to come back in the queue. There's a long queue behind, please.
Yes, sir. Please rejoin the queue for follow-up questions. And maybe request all the participants to use their handsets for optimum audio quality in the conference. Thank you. The next question is from the line of Uttam Kumar Srimal from Axis Securities Limited. Please go ahead.
Good morning, sir. Thanks for the opportunity. Sir, what would be our capex guidance for FY25 and FY26?
26, we have not yet formed up a capex. FY25 will be close to probably 350 crores or so.
Okay. And sir, how much amount is remain to be collected from Afghanistan currently?
कितना है राजेश?
So roughly about 400 crores we have collected in the last.
कितना बाकी है?
Remaining is about 300.
Net कितना?
Net 300.
Around 300 crores.
300 crores. And sir, with regard to interest cost, so this will remain same in FY25. What has been in FY24? Total amount?
FY24 was high. We were at 3.3% of revenue. FY25 we are guiding almost at the same level of Q4 of 2.5%.
Correct.
Okay, sir. That's all from my side and all the best.
Thanks, Uttam. Thank you.
Thank you. The next question is from the line of Ria from Equitas. Please go ahead.
Thank you for giving me the opportunity. My first question is in regards to the supply chain challenges that we are seeing. So what kind of inventories do we keep for conductors and if we are planning to set up our own manufacturing facility, what kind of capex are we seeing there?
So, I answered it earlier. We are planning a capex of 60 crores for the conductor. Secondly, we don't have any inventory of conductor. It basically is ordered for project to project and it goes to the project site and is installed quickly. So we don't have any inventory.
Are we seeing any price hike from the suppliers?
There are marginal price hikes which are happening and which will apply to the newer projects. So that is factored into our tender costing when we tender for a new project. Old ones, generally we have not seen anything which is significant. But let me tell you that aluminum conductors are always on a price variable. So when you talk about price hike, if the metal goes up, the price will obviously go up.
Right. And in terms of AL59 conductor, which we are speaking about, what percentage of our total orders or the order inflow which we are seeing would comprise of that?
So as far as power grid is concerned, probably 75-80% or HVDC में नहीं है, but बाकी में तो है ही ना. Yes, almost I'll say 75-80% of the orders would have AL59.
Okay. And you also mentioned that there is a supply issues in DI pipes as well. However, large water projects are drying up going forward. So what is your outlook over there?
I think that is the expectation that with the water projects drying up in a fashion, the DI pipes should improve availability. Number one. Number two, we have seen that most of the players have expanded capacity. So I think the expanded capacity is slowly coming into production. I know at least 2 or 3 of them who have started supplying from their new capacities. So I think it's a matter of time that maybe in a quarter or so, this will become normalized.
Got it. And what kind of water projects decline or degrowth are we seeing at? Like, if you just to give a perspective in context.
No. For example, this year we did not get a single water project. Well, there were hardly any bids which were announced. Last year, Nagesh would have won 2,000 crores last year. 2,000. So in FY23 we had got a 2,000 crore projects in water. FY24 was 0.
Got it. Okay, that's it from my side. Thank you so much.
Thanks, Riya. Thank you so much.
Thank you. The next question is from the line of Arafat Sayed from InCred Research. Please go ahead.
Yeah, hi sir. Thanks for taking a question. I'm audible?
Yeah. Go ahead.
Yeah, so just want to understand, let's say, more about the international pipeline. You said close to 40,000 crores is still available. So can you just brief me about what exactly, in which region you're looking for these kind of opportunities?
So, largely it is Middle East. Okay? Largely. It is between Saudi and Abu Dhabi. Then there are part of it is in Africa, and then balance is, spread over East Asia and Americas, etc.
Okay. And sir, my next question, again, opportunity. I just want to understand, let's say, what happened in last, let's say, 6 to 8 months, that suddenly the opportunity has increased significantly, especially on the both India and international T&D. So I just want to understand, let's say, which segment, or let's say from where this opportunity coming in India and also from the international market.
So, Arafat, international, there has not been any major change in the outlook and all that. That's why we did not say that international will grow significantly. It's growing well, and the opportunities are basically in two areas, which is the Middle East, which is both UAE and Saudi, and also in the North America, especially US part of it, where we are seeing opportunities. But that's a typical growth of 10-15%, which we will have. Okay. India, I think what has changed, probably a year and a half back, or whatever time, we had large power cuts, etc. And that was the time when I think suddenly the government realized that they need more power, and the entire thinking on the Ministry of Power changed from not adding capacity both on the supply side and on the T&D side. That's number one. Number two, what happened was that with the way Prime Minister was heading the G20 and, the entire focus on green energy, suddenly the government went all out to ensure that renewable capacity is added. Now, most of the renewable capacity, you are aware, is coming up in Gujarat and some parts of Gujarat towards the Pakistan border, and also a large part is coming in Rajasthan. So, obviously, that needed large lines. So, that was the second part. The third part was that earlier, the transmission guys used to wait for the power plant, for the renewable plants to be set up, start working, and then start transmission lines. And then that resulted in the solar plant getting ready and the transmission line not being ready. So somewhere the CEA has taken a call saying that once approval has been given for a solar or a wind farm, let the transmission line be set up irrespective of whether the power generation is happening or not. So suddenly they have pushed the REC and PFC, etc., or the nodal agencies for TBCB to go ahead and start implementing all the notified schemes without waiting for the solar plant or this to come. So I think these are the 2 or 3 major changes which we see, which have resulted in this push for more of transmission. Let me add on something is today, as KEC, we are almost doing 3 or 4 lines which is bringing more power to Mumbai. So also the power demand itself is going up significantly. We are building 4 data centers. Each of them is consuming huge power. So the inherent demand for power has also gone up apart from the push for renewables. I hope I'm clear.
Yes, thanks, sir. That's all, my side.
Thanks, Arafat. Thank you.
Thank you. We'll take the next question from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah. Namaskar, Vimalji. Namaskar, Rajivji. Sir, when you mentioned about 60 crore capex, it is only for the conductors, or do we have any additional line for cables also?
नहीं, ये खाली कंडक्टर के लिए है.
And sir, इससे हमें 600 crore की top line मिलेगी?
हाँ जी.
Okay, and when will this get commissioned?
So we are targeting for Q3.
Q3 of this financial year.
Yeah.
And sir, then the conductors में margin भी हमारे profile definitely higher रहेंगे cables से?
Depend करेगा. देखिए, I'll look, Saket sir, what is happening is that the conductor price will be decided by the demand supply, which obviously today is in favor of the suppliers. So margin would depend upon, we have some orders for outsiders, so जो बाहर supply के उससे margin बढ़ेगी. Internal, so we'll probably have some margin getting built into our transmission business. But overall, yes, there will be an improvement in the overall numbers.
So when you look at the cable business as the other segment classified, the revenue was flat, but there is an improvement in margins. So for the next year, हम cable segment से कैसा margin profile expect करते हैं with I think so back-to-back contract हमारे commodities के लिए lock किए हुए हैं. And for the cables also sir हमारा split up क्या है between EHV and the high voltage cables and any other profile?
So difficult to give you exact numbers. I don't have those numbers, but मेरे हिसाब से EHV और HV मिला के करीब 400-450 करोड़ का टर्नओवर है, सब 1600 करोड़ में से.
और बाकी का सर?
बाकी तो LT है, इंस्ट्रूमेंटेशन है, टेलीकॉम केबल्स है, कई चीजें हैं उसके अंदर. कॉपर केबल्स है रेलवे के लिए.
एक और स्मॉल पॉइंट, HPPPR में भी सर हेलोजन फ्री में भी हम क्या इस प्रोडक्ट को भी कंसीडर कर सकते हैं कि ये फिर कंज्यूमर ओरिएंटेड हो जाएगा?
मंजी
HPPR हेलोजन फ्री
कंज्यूमर में नहीं कर रहे हैं अभी हम लोग. नहीं.
राइट. एक स्मॉल पॉइंट राजीव जी, हमारा फॉरेक्स का इम्पैक्ट क्या था इस क्वार्टर के लिए एंड फॉर द ईयर एज अ होल?
Sajid, forex impact for this year has been very negligible. I think must be 5-7 crore here and there. Reason being that our most of the ordering which is happening is in the Middle East. Middle East, the currency is packed, and a lot of these orders are coming up in our subsidiary companies in Dubai and joint venture in Al Sharif KEC. So there is not significant foreign exposure that we have currently. Whatever we are doing, let's say in other jurisdiction, we are either hedging them, either selling those currencies, or we are actually taking borrowing against that. So effectively, to that extent, our borrowing interest cost gets reduced to the extent of hedging against those contracts. So foreign exchange, I don't think there is a significant variation this year.
Okay. And sir, Vimal, the last point on the 400 crore deferred revenue, I missed your point. Which segment it was and when will those get accounted for?
So largely transmission and some part of it in civil. जो DI pipes का supply का shortage था. So part of DI pipes were not supplied and partly on account of conductors and a little bit of transformers which did not happen because of the Red Sea. तो कुछ जगह से हमारा Middle East में the supplies come from Europe. So some part of the European supplies got deferred. Those are two major reasons: water, that's civil, and in transmission.
And this DI pipe issue is resolved now. Deliverables have come. It is domestic issue or for foreign land?
International. It is domestic issue. DI pipes is for a water project. So government has given a lot of water projects. अब बीच में थोड़ा कम हुआ है, तो availability improve हो रही है. Plus, what has happened is all the DI pipes manufacturer expanded capacity. So I think it's a matter of time. मतलब it is only a deferment of revenue. Q4 के बदले Q1 में आ जाएगा या Q2 में आ जाएगा. इससे कोई खास विशेष चिंता की बात नहीं है.
एक पॉइंट और था सर, आज जैसे हमने न्यूज़पेपर में देखा, देयर इन टर्म्स ऑफ टाइम ओवररन 109 ऑफ दी 249 रेलवे प्रोजेक्ट्स फेस टाइम ओवररन. सो अभी हमारी जो रेलवे की ऑर्डर बुकिंग है और जैसा आप आउटलुक दे रहे हैं रेलवे के लिए, हाउ डज दिस कम इनटू इम्पैक्ट, जिसमें हम टाइम ओवररन देख रहे हैं इन मेजॉरिटी ऑफ द रेलवे प्रोजेक्ट्स? इसको कैसे हम आंकलन करते हैं KEC के लिए?
ये बहुत मुश्किल चीज है साकेत जी, बिकॉज क्या हो रहा है ना कि अब मैं गिव एन एग्जांपल. एक हमको टेंडर मिला था, उसमें लिखा था कि हम 18 घंटे का ब्लॉक देंगे आपको रोज काम करने के लिए. 18 घंटे के बदले 4 घंटे का ब्लॉक मिला, क्योंकि किसी ने अप्रूवल नहीं किया कि ट्रेन रोक के इनको पहले काम करने दो. तो जब तक वो इशू रिजॉल्व नहीं होगा और एक रियलिस्टिक टाइमलाइन नहीं बनेगी कि भाई आपको काम, हम आपको इतने घंटे काम करने देंगे. इट इज ऑलमोस्ट लाइक ROW इशू इन ट्रांसमिशन ऑल दैट ना. यहाँ पे क्लाइंट खुद ही काम नहीं करने देता है. तो जब तक वो इशू रिजॉल्व नहीं होगा कि भाई रेलवे प्रोजेक्ट को किस तरह से करना है, तब तक हमने तो अब क्या कर दिया कि जो मोटा मोटी जो प्रोजेक्ट रेलवे लाइव लाइन पे काम करने हमने बंद कर दिए लेने, क्योंकि वो सोल्यूशन नहीं निकल रहा है उसमें. जब तक वो सोल्यूशन नहीं निकलेगा कि भाई 10 घंटे 12 घंटे आपको काम बंद, लाइन ट्रेन बंद करके काम करने देंगे. होपफुली अब इलेक्शन हो गए तो मे बी समबडी में टेक सम अनपॉपुलर डिसीजंस के भी ट्रेन बंद करके जो मॉडिफिकेशन करना है, जो वो करना है वो कर दो. तो वेट करना पड़ेगा. मेजर कारण ही लॉसेस का वही है कि आपके सारे प्रोजेक्ट प्रोलॉन्ग हो गए.
सही बात है. और सर केबल में हमने कंपाउंड के लिए भी कोई वर्क किया है? XLP कंपाउंड एंड ऑल जो EHB में लगते हैं, उसके लिए भी कोई इंटीग्रेशन है कि वो हम मार्केट से ही सोर्स करते हैं?
एक्सेल पे मार्केट से करते हैं। पीवीसी का हमने हमारा खुद का बैकवर्ड इंटीग्रेशन प्रोजेक्ट लास्ट ईयर किया था, जो इस साल शुरू हो गया। आपने सवाल पूछा ना मार्जिन क्यों इंप्रूव हो रही है, वन ऑफ द रीजंस फॉर द पीवीसी कंपाउंडिंग व्हिच वी आर डूइंग आवरसेल्व्स।
राइट। एंड ईएचवी में कोई कैपेसिटी एडिशन सोच रहे हैं जॉइन द क्यू नो?
नहीं कर रहे हैं।
हमारे पास सफिशिएंट कैपेसिटी है करंट मीट करने की।
सफिशिएंट का तो कोई डेफिनेशन नहीं होता है ना, तो बट जो है वो है, अभी एक्सपेंशन नहीं कर रहे हैं उसमें। थैंक यू साकेत जी।
एंड डिविडेंड के लिए धन्यवाद।
धन्यवाद सर।
Thank you, sir. The next question is from the line of Dhruv, an individual investor. Please go ahead.
Yeah, hi sir, good morning. Congratulations on the good set of numbers. Sir, I wanted to understand that if in an EPC project, the project size is suppose rupees 2,000 crores in the transmission segment, then how much cost is incurred on towers in that 2,000 crores? And if you can give the rough idea on how much percentage is spent on substation, cables, poles, and other parts for this cost bifurcation, sir?
So it would depend upon where the project is coming. What sort of combination you are using? Six conductors, multi-circuits. There are a lot of combinations. But if you ask me, in a typical environment, it will be we always call one third. One third is construction, one third is tower supply, one third is conductor and other insulators, hardware, etc. That's a very standard ballpark which you can take. कि भाई ऐसा है. If the lines are very long, it may be very different. Somewhere today, when we are seeing AL59, etc., where the conductors are very heavy and more, I'll say, expensive technology-wise, conductors itself are becoming 40%. So 50% supply हो सकता है, 20-25% टावर हो जाएगा, बाकी कंडक्टर हो जाएगा, बाकी कंस्ट्रक्शन हो जाएगा. Substations is very difficult to give an answer. Okay. Because substation में क्या हो रहा है कि क्या configuration है, क्या नहीं है, very difficult. But if you ask me, around 80% would be supplies, which would be transformers and whatever else is there in that CRP, SAS, etc. And 20% would be construction.
Okay, fair enough, sir. Sir, on the solar side, what is the order book as of now stands at, and going forward, how do you see the segment going forward for you, sir?
So solar, I think our order book is up around 300 and odd crores or something. I don't have the exact number, but us ballpark mein kahin hoga. We are waiting and looking. We have been bidding for some projects because solar mein kafi project aa rahe hain, but un sabki the risk profiles are different. So whatever risk profile suits us, where the liabilities etc., we are willing to take. Those are the projects which we are bidding for. I don't think we are bidding very aggressively. So maybe we'll take 1 or 2 more projects or maybe 3 projects. I do not know this year. And depending upon how the performance happens, then we will probably go more aggressively in this business. I think FY26 is a year when we will probably have a much larger revenue arising out of this.
Okay, so there is no plans right now in the FY25 to expand this segment very aggressively, sir?
So I said that we may take 2 or 3 projects, and individually each project is around 500-600 crore. So we may get an order book of maybe 1,000, 15 or maybe 2,000, depending on how lucky or unlucky we are. Maybe we should get an order intake of maybe 2,000 crores.
Okay, sir. Okay. Thank you so much, sir, and all the best for the future.
Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for today. I would now hand the conference over to Mr. Vimal Kejriwal for closing comments. Over to you, sir.
So thank you very much for your continued interest in KEC. Thank you. And I think we are pretty confident of delivering on the numbers what we have talked about. Thank you. Thanks, Michelle. Thank you so much.
Thank you, sir. Thank you, members of the management. Ladies and gentlemen, on behalf of KEC International, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.